Hi guys. Today we will analyze Becton Dickinson stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. However, recent evolutions are not positive. The long-term trend is still neutral, but the short-term trend is negative. It is advised to wait a little bit longer to see how this turns out. Strong support levels are around $233 and $222. Next strong support level is around $215. Strong resistance levels are around $245 and $257. Next strong resistance levels are around $268 and $275. In the last month the stock has been trading between $232 and $252 range. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 1 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 11% per year, for last 5 years. We see that the average profit margin of the stock has been around 6% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 319% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Becton Dickinson Company: bad, average, and good. First scenario. Becton Dickinson will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 6%. Future profit margin would be low, 6%. Future free cash flow to net income rate would be low, 100%. In this case, the fair value of the stock today would be $129. Second scenario. Becton Dickinson will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 7%. Future profit margin would be average, 7%. Future free cash flow to net income rate would be average, 110%. In this case, the fair value of the stock today would be $169. Third scenario. Becton Dickinson will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 8%. Future profit margin would be high, 8%. Future free cash flow to net income rate would be high, 120%. In this case, the fair value of the stock today would be $216. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 6.35. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Becton Dickinson, analysts forecast growth rate around 8% per year in next 5 years, and future P/E around 22. Again, I will use 3 different scenarios for Becton Dickinson Company: bad, average, and good. First scenario. Becton Dickinson will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 6%. Future P/E would be low, 18. In this case, the fair value of the stock today would be $82. Second scenario. Becton Dickinson will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 7%. Future PE would be average, 22. In this case, the fair value of the stock today would be $109. Third scenario. Becton Dickinson will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 8%. Future PE would be high, 26. In this case, the fair value of the stock today would be $140. As you can see, today the stock is overvalued, $244, even if we expect the company's high performance in future. While the company has a good profitability rating, there are some minor concerns on its financial health. Also, the stock is expected to show a small growth in revenue in the next 5 years, 6 to 8% yearly. Based on that, the stock looks overpriced at the moment. Becton Dickinson is a dividend king. I may consider buying the stock for the dividend, when the stock drops below $215. Company strengths. Becton Dickinson and Company, also known as BD, is an American multinational medical technology company that manufactures and sells medical devices, instrument systems and reagents. BD also provides consulting and analytics services in certain geographies. BD has a robust pipeline of products to further catalyze returns. Market demand for medical devices is stable. BD's massive scale and wide range of products makes it a preferred vendor for healthcare facilities. As the world's largest manufacturer of needles and syringes, BD is also benefiting from the ongoing large-scale vaccination and testing campaigns. BD also has a leading peripheral artery disease franchise, with significant market growth opportunities. Having completed the diabetes care spinoff, BD will deploy capital to drive growth in its medical, life sciences and interventional business segments. BD is a dividend king that generates tons of cash. It has raised its dividend for impressive 50 consecutive years. The stock currently has 1.42% dividend yield. The company's return on assets of 3.5% and profit margin of 9% are amongst the best returns in the industry. Its return on equity of 8% is in line with the industry average. Risks. The company operates in many competitive markets with volatile regulations and shifting healthcare industry practices. BD has a number of rivals, such as Abbott and Roche, that possess greater marketing reach and larger research and development budgets. The company faces risks from the integration of acquired businesses. With nearly half of revenue coming from overseas, the company also faces currency risk, as well as operational risks. The company faces risks due to supply chain issues. These issues affect the ability to source sufficient quantities of materials and components, as well as the pricing of these production inputs. The Alaris recall could be a meaningful setback for the BD's market-leading pump franchise. Also, the paclitaxel issue was a material setback for the company's drug-coated balloon franchise. There is uncertainty around future products in this area. BD has also had a slightly elevated level of debt in recent years, which the company is working on paying down. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 6 to 8% on average per year. The earnings per share is expected to grow by 6 to 10% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.